Massive Q2 beat for Texas Instruments. I mean, they absolutely crushed consensus. Revenue came in at $5.46 billion, EPS hit $2.14, and third quarter guidance is pointing even higher, forecasting revenue between $5.65 and $6.15 billion. The momentum here is just undeniable.
Yeah, and the stock is reacting exactly how you'd expect, right? It's popping in after hours trading because that forward guidance is a massive signal of strength to the market.
Totally. Welcome to your custom-tailored deep dive. Today, we are tearing into Texas Instruments Q2 2026 earnings report, which just dropped on July 22nd.
And we are looking strictly at the raw materials today. So TI's official press release and their consolidated financial statements for the second quarter.
Right. And, when you look at financial reports with this level of granularity, they really act as the ultimate report card for the broader tech industry. We're unpacking a quarter where the numbers point to pretty tectonic shifts happening in industrial and automotive tech.
Yeah, TI is a classic bellwether. I mean, their chips are foundational to almost every electronic device out there. So their operational performance gives us this highly accurate read on the macroeconomic environment.
Because if their numbers are accelerating, it tells us that manufacturers are actively deploying capital.
Right, exactly. The folks building cars, scaling data centers, deploying industrial equipment, they are spending money.
So let's get right back to those top-line numbers. Q2 revenue of $5.46 billion. That represents a 23% increase year over year from the $4.448 billion they posted in Q2 2025. And we also saw a 13% sequential increase.
And that sequential growth metric is critical here. It demonstrates immediate near-term acceleration in customer orders.
Right. They aren't just relying on an easy year-over-year comp.
Exactly. It proves management isn't just coasting on a weak quarter from last year. The demand curve is steepening right now.
And the bottom line is where the numbers start to look genuinely staggering. Net income hit $1.98 billion, which is a 53% jump year over year. EPS at $2.14 represents a 52% increase from a year ago.
It's a remarkably clean sweep. Top line, bottom line, and forward guidance all beat consensus. That specific combination is, well, it's the holy grail for institutional investors.
Validating the current quarter while raising the ceiling for the next.
Right. That's what locks in a long-term growth narrative and stabilizes the stock post-earnings.
But hold on, we need to look closer at that EPS number because there's this very specific footnote in the press release.
Oh, the 5 cents.
Yeah. Management explicitly states that the $2.14 EPS included a, and I'm quoting here, 5-cent benefit that was not in the company's original guidance. I look at a company pulling in nearly $2 billion in pure profit, and I have to ask, why highlight a 5-cent benefit?
It seems trivial, I know.
It feels like a rounding error at this scale. Why draw attention to it?
Well, it feels microscopic to a retail observer, sure, but it speaks directly to the mechanics of institutional modeling. Analysts build their discounted cash flow models down to the fraction of a penny. Management teams know this, so when they issue guidance, they're constructing a very deliberate conservative floor. Highlighting that 5-cent beat is management's way of signaling that they found unexpected operational efficiencies.
Or they just enjoyed stronger pricing power than their internal models predicted.
Precisely that. And when you factor in TI's roughly 920 million shares outstanding, that 5 cents translates to about $46 million in unexpected net income dropping straight to the bottom line.
Wow, okay.
Yeah. It's not just loose change. It's a massive injection of unplanned capital that signals absolute operational control.
That reframes the footnote completely. It's basically a flex. So to understand why revenue jumped 23% and generated that level of profit, we have to look under the hood at the segment breakdown.
Right. CEO Haviv Ilon specifically attributed this broad growth to 3 sectors: industrial, data center, and automotive.
And those end markets are highly capital intensive, relying heavily on the 2 specific categories of chips that TI produces at massive scale. Starting with the heavyweight, the analog segment.
The bread and butter.
Exactly. Revenue here was $4.365 billion, up 26% year over year. Operating profit hit almost $2 billion, a 50% increase.
Analog chips are the physical bridge for digital systems. They manage power, regulate voltage, and the product life cycles for analog chips are incredibly long, sometimes lasting a decade or more.
Which makes this segment highly sticky and very reliable. It's the engine of the company.
Definitely.
But then you have the embedded processing segment, which is where the math gets wild. This is a much smaller division, bringing in $788 million in revenue this quarter. That's a respectable 16% top-line growth.
Solid growth, yeah.
But the operating profit for embedded processing went from $85 million last year to $168 million this quarter. That is a 98% jump in operating profit on only 16% revenue growth.
That disparity right there is arguably the most important metric on the entire income statement this quarter.
I need you to explain the mechanics of that, because on a spreadsheet, it looks like a glitch. How does a business unit sell only 16% more product, but effectively double its operating profit?
You are looking at the raw power of operating leverage. To understand this, you have to look at the cost structure of a fabrication plant, a fab. The fixed costs are astronomical.
Right, you're building clean rooms.
Clean rooms, installing hyper-expensive lithography equipment, running massive utilities 24/7. Management has to pay those fixed costs regardless of whether the fab produces 10 chips or 10 million chips.
The baseline burn rate is massive before a single chip even ships.
Exactly. But once production volume scales high enough that the revenue covers those fixed costs, the break-even point, the economic profile of the fab flips.
The marginal cost to produce the next wafer drops.
It drops drastically. It's incredibly low. So when TI increased their embedded processing revenue by 16%, they were already operating past their fixed cost break-even point.
Oh, wow. So almost every single dollar of that new revenue bypassed the cost of goods sold.
And dropped directly to the bottom line as pure operating profit.
That makes total sense. They already paid for the factory and the machines. The extra 16% in sales just cost them raw silicon and some electricity.
And that margin expansion creates an immediate liquidity event, which feeds directly into the cash flow statement.
Let's transition to that cash flow, because the numbers here are staggering. Trailing 12-month cash flow from operations hit $8.667 billion.
Huge numbers.
Free cash flow for just Q2 was $2.738 billion, which is a 271% increase year over year. But the metric that really stands out is the margin. Free cash flow as a percentage of revenue jumped from 10.6% a year ago to 33.6% this quarter.
That conversion rate is phenomenal. But, any analyst looking at this report is going to immediately isolate the line items driving that specific surge.
Which brings us to the THIPS and Science Act.
Right.
The cash flow statement reveals that TI received $549 million in direct proceeds from U.S. government subsidies this quarter. Additionally, they used a $301 million investment tax credit, reducing their cash taxes.
So combined, that is an $850 million cash benefit injected directly into their Q2 liquidity profile.
Now, from an accounting perspective, and keeping this totally impartial regarding domestic policy, this is a structural alteration to their balance sheet.
The U.S. government is effectively co-funding their capital expansion.
But here is where I have to push back on management's presentation. They include this $850 million in their free cash flow calculation. But free cash flow is a non-GAAP metric, right? It's not bound by strict accounting rules.
Right, it's a bespoke number.
Aren't they artificially inflating the strength of their underlying business model by tossing government subsidies into a metric investors use to judge operational health?
Your skepticism is completely warranted, and this is exactly why institutional analysts strip non-GAAP metrics down to the studs. Management teams usually use non-GAAP figures to present the most favorable view.
Like excluding stock-based comp.
Exactly. In this case, TI argues that including the GPS Act proceeds gives investors an accurate picture of the actual usable liquidity sitting in their bank accounts.
Because at the end of the day, the cash clears. It's real money they can spend.
Correct. The liquidity is genuine. However, if you are modeling the long-term organic run rate of their core business, you have to mentally back that $850 million out.
You have to separate the chip they're actually manufacturing from the capital injected by the government.
If you don't untangle those two streams, you fundamentally misunderstand the company's independent margin profile.
So the cash is real, but the source of the cash dictates how we should value the operational machine. That leads directly into capital allocation. With billions in free cash flow, augmented by these incentives, where is that capital going?
Capital allocation is the clearest window into a management team's strategic thesis. It tells you if they're prioritizing immediate shareholder returns or building a moat for the next decade.
Well, over the trailing 12 months, they invested $3.9 billion in R&D and SG&A, and they deployed $3.3 billion into CapEx. At the same time, they returned $5.8 billion to shareholders.
But the internal breakdown of that return is where the strategy shifts.
Dramatically. Dividends paid were $5.112 billion, up 4% year over year. But stock repurchases plummeted to just $707 million. That is a 61% drop from the $1.81 billion they spent on buybacks in the previous 12-month period.
Pumping the brakes that hard on stock buybacks while flush with cash is an aggressive strategic pivot.
It reminds me of a homeowner who suddenly finds themselves with a massive influx of cash. You can give your family a larger allowance, which is essentially paying a dividend, or you can use the cash to buy out your partner's equity in the house.
Which is the stock buyback.
Right. TI kept the allowance steady, raising the dividend by 4%, but they practically stopped buying out equity. Why abandon the buyback strategy when they have the cash to support it?
You have to look at the other side of the ledger, specifically that $3.3 billion in CapEx. In the earnings commentary, Haviv Island pointed directly to the strategic importance of 300mm production.
Break down the mechanics of that. Why does a 300mm wafer justify a 61% cut in stock buybacks?
It comes down to the geometry and physics of semiconductor manufacturing. Older, legacy fabs process 200mm wafers. TI is transitioning heavily to 300mm.
So it's larger.
Right. A 300mm wafer has roughly 2.25 times the surface area. This means you can print significantly more individual chips on a single wafer.
Which fundamentally alters the unit economics.
Drastically. The time and chemical processes required to treat a 300mm wafer are very similar to a 200mm one, so your yield per batch more than doubles without a proportional increase in variable costs.
Cost per chip plummets.
Giving TI a structural pricing advantage over competitors still on 200mm fabs. But here is the catch. Building the advanced facilities capable of handling these larger wafers requires a staggering amount of upfront capital.
So they are rerouting the cash they would have spent artificially inflating their EPS through buybacks and pouring it directly into physical infrastructure.
Infrastructure that guarantees a lower cost structure for the next 10 years. They are prioritizing a permanent operational moat over short-term financial engineering.
Which projects immense confidence. But, when you scroll past the headline numbers and the strategic CapEx investments, you hit the legal disclosures. And the forward-looking statement section paints a much more cautious picture.
The safe harbor section is rarely just boilerplate in this industry. It's a real-time risk assessment.
They outline several evolving threats, evolving cybersecurity vulnerabilities across their supply chain, intense price competition, shifting global trade policies.
Which is a massive variable when your supply chain spans multiple continents. A single tariff can instantly disrupt the margin profile they just spent billions trying to optimize.
But there's one specific risk factor that jumped out to me because it feels like a glaring contradiction. They explicitly warn about, quote, market demand for semiconductors, particularly in the industrial and automotive markets, and customer demand that differs from forecasts.
I see the disconnect you're pointing out.
Right. At the top of the press release, the CEO is taking a victory lap about broad growth led by industrial and automotive. It's the headline of the quarter. But buried in the risks, management warns demand in those exact same markets could suddenly evaporate.
It looks entirely contradictory on paper, I agree.
How do they reconcile bragging about a market in one breath and warning about its collapse in the next?
It perfectly encapsulates the brutal reality of semiconductor cyclicality. What you are seeing is the friction between trailing performance and forward-looking supply chain dynamics.
Walk me through how those supply chain dynamics actually trigger that cyclicality.
The semiconductor industry is famous for its boom and bust cycles, driven by the bullwhip effect. Right now, industrial and auto sectors are booming. Auto manufacturers are integrating more chips than ever.
For EV battery management and driver assistance systems?
Right. But fab has incredibly long lead times. It can take 3 to 6 months from the time a wafer is started to the time a finished chip is shipped.
Which completely clashes with the just-in-time manufacturing model car companies prefer.
Exactly. So when auto manufacturers see a surge in demand, they panic about chip shortages stalling their assembly lines. To protect themselves, they overorder. They double or triple their typical purchase orders for buffer inventory.
Ah. So the 23% revenue growth TI is reporting isn't just organic demand. It's heavily subsidized by customer panic and inventory hoarding.
That is the structural vulnerability. Management knows today's top-line beat is partially driven by clients' stockpiling. And what happens when those clients finally feel secure about their inventory?
They halt new orders entirely.
They undergo a massive destocking phase where they just burn through the chips sitting in their warehouses.
RIT means TI's revenue could flatline in those sectors for a quarter or two, even if end consumer demand for cars remains steady.
Precisely. The exact sectors generating today's record margin are mathematically guaranteed to be the source of tomorrow's sudden revenue drop.
Wow.
TI's management is acknowledging that the boom they are currently riding is planting the seeds for the next cyclical bust.
It's a masterclass in managing expectations. They are banking the cash during the feast, investing in 300-millimeter infrastructure, but legally signaling to investors that a famine is inevitably coming.
It's a fundamentally pragmatic approach to running a highly cyclical business at a global scale.
So let's distill this quarter down for you. Texas Instruments printed a phenomenal Q2, a 23% expansion in revenue, a massive demonstration of operating leverage, yielding a 98% profit jump in embedded processing.
And that strategic pivot away from buybacks to fund next-generation fabs.
But underlying all of this operational excellence is an $850 million liquidity injection from the GPS Act and this looming anxiety about inventory destocking in their core markets.
The balance sheet is impenetrable today, but management is preparing for a much harsher climate tomorrow.
Which leaves you with a critical question to consider as you evaluate the broader tech landscape. TI utilized $850 million in government subsidies to drastically boost their free cash flow profile this quarter alone. As you look at other semiconductor giants reporting the season, you have to ask, how much of the industry's current free cash flow narrative is a product of true operational dominance, and how much is currently being underwritten by federal tax credits?
Are these companies really as invincible as their balance sheets suggest, or is government intervention masking those underlying cyclical risks?
Exactly. Something to think about. Thank you for joining us for this deep dive into Texas Instruments' Q2 report. If you want to keep untangling the market's biggest stories and separating organic growth from accounting noise, make sure to follow the show for our daily earnings coverage. We will see you next time.